Coming up in today's video, we'll talk about the stock market just about to hit another all-time high here as we had a mixed trading week. The stock market is dropping huge right now as Trump is calibrating increased tariffs on Chinese products. And Trump said he was planning to meet Xi in 2 weeks, and now that there seems no reason to do so. And he says many countermeasures are under consideration on China. And just look at the NASDAQ on a 15-minute chart. The dollar is also dropping huge. And despite the pullback in gold yesterday, gold is right back up today. And towards the end of this year, we're expecting a rally in the stock market based on seasonality, but I wonder if this throws a wrench into that seasonal expectation. Precious metals sold off yesterday, but was that all we're going to get for a pullback? And is gold headed back to new highs? The dollar index broke out this week. Does this have sustainability to it? And are we headed to 100 on the DXY? Volatility remains pretty quiet out there in markets, but not so much for oil prices, as we see new lows for WTI coming in at $60 a barrel here this morning. What does this mean for other markets as well as oil itself? Bitcoin also is consolidating towards all-time highs. Is there upside for this one? And what's going on with the Japanese yen, which has shown a lot of weakness here? Dollar yen breaking to the upside here. All of that and more in today's video. Make sure to hit the thumbs up button, subscribe if you're new. Let's jump in. So the overall bias for the US stock market remains very bullish overall. We can still see that despite some things that are a little bit uncertain under the surface with the government shutdown, etc., the lack of data, the stock market has found a pretty resilient pause point here, pretty much printing a barcode this week and not really making any sort of substantial move as we wait for the government shutdown to figure itself out. In my opinion, the macroeconomic data still suggests that stocks can remain elevated and that although they are expensive, they are deservedly so. From a technical basis, I think this consolidation at the highs is not something we should read too much into. If we do pull back and get a larger retracement down to like the 65, 75 level, I would personally take that likely as an opportunity to get long and to buy the dip. Let me explain what I mean by the macro still looks okay here. Growth in the United States has remained relatively resilient with 3.8% GDP growth in an environment where we only have 4.3% unemployment rate. This is a pretty strong backdrop for the economy. Now, there are some threats building on the jobs data side of things, but we are still in the blind here. With the government shutdown, we have not received fresh NFP data, which many traders and investors were looking forward to getting some more clarity, not least of which, of course, is the Fed, who is also looking very close to see what the jobs data is looking like for prospective rate cuts that are expected to come in the rest of this year and into next year. Speaking of rate cuts, this is a tailwind to the US stock market and to the US economy as well. If you do get rate cuts, what does that do for the consumer? Well, it suggests that lower borrowing costs could make it so that consumers are more able to go out and spend money, which ultimately is what drives the stock market higher, is earnings. If the stock market is producing strong earnings, it can remain bullish, right? Growing earnings, growing companies, that's good for the stock market. So good consumer spending would be really important, I think, to this market. And we can actually look at that with the retail sales number. What we're looking at is retail sales, which is a month-over-month reported data, which gives us some insight into, well, retail sales. It tells us what the consumer is out there doing. And we've actually had pretty impressive consumer spending here as of the latest data. We had a 0.6% reading, and this red dot was the forecast. We were forecasting 0.2%, we got 0.6%. So consumers are still out there spending, at least for now. Importantly, the reason that consumers are still out there spending is because people are still employed for the most part. We could take a look at the unemployment rate the last few years, which came down following the COVID pandemic and has pretty much remained at a very low historical rate. Now you might be saying, well, what about the jobs market? Isn't the jobs market bad out there? Well, the answer is if you're someone trying to get a job, it's not great. In fact, hiring has really slowed in the United States, but existing jobs, there's not big firing going on, at least as of the latest data that we have available to us. Firing is not happening, but also hiring is also really slow. We can see that in the JOLTS job openings in the United States, which has been in decline for some time. There's just less jobs available here recently. And while we did see an initial spike in jobless claims, people maybe potentially getting laid off, we saw that get muted. However, we are still in the blind with the latest unemployment claims data sort of out of vision due to the government shutdown taking place right now. But it doesn't take a genius to look at the non-farm payroll over the last few years and see that we are in a downward trend. There's less jobs being added in the US economy, which is suggesting a weird environment, which is we have an environment where there is low hiring, but also low firing. People who have jobs are keeping their jobs, but people who don't have jobs are finding it hard to find jobs. Perhaps a part of this reason is because companies are still uncertain around the whole tariff dynamic and what that means for prices in the future. And so there's a lot of like on pause that's going on. There's also the introduction of AI and just how much that disrupts a lot of the junior hiring roles. I know one area of the economy that is really struggling with getting jobs is people that are earlier in their careers, where the more junior roles are potentially more threatened by AI in the short term. And though it's a little dystopian, the idea that AI is taking jobs is still a very positive thing, at least for now, for corporate earnings. I know that sounds really, kind of pessimistic and dry, but it is true. If you can save money in terms of your hiring with replacing junior workers with AI, that is just straight up more profit for big corporations, which is ultimately why I think the stock market is also buoying higher, as AI is an exciting story for corporate efficiency, where they may need to hire less very expensive workers. As with most businesses, the payroll and people involved are the most expensive part of running a business. Just take a look at the NASDAQ, which is also sitting at all-time highs. I think the idea here is, again, be patient. We will likely get dips eventually. Well, we certainly will eventually. It's just a matter of when. And so I am still bullish, but just waiting for pullbacks, and there's not much more I can do with that. And if you're looking to get funded this year, check out our sponsor of today's video, DNA Funded. They're currently offering 20% off to subscribers of my YouTube channel if you use the promo code right here, A1T20. Simply scan the QR code if you want to check out the different challenges that they offer. And if you are looking to get funded this year, I like DNA Funded because they come from a background of DNA Markets, right, which is an established brand and brokerage in the retail trading space that has been around for some time. I think when it comes to trading with prop firms, going for the more professionally run businesses are the places to be, in my personal opinion and experience in terms of working with and speaking with a lot of different prop firms in my role as a creator. I've chosen to work with DNA Funded because, again, their professionalism stands out. And again, they're offering a really nice discount to existing subscribers of my YouTube channel. Check out them with the QR code or the link in the description down below. Use promo code A1T20 to get 20% off their challenges. Taking a look at the dollar index, we had a really strong breakout here this week. Very nice break above the 98.50 level, and we stayed decisively above that. If we do pull back into this area of support, my best expectation or best guess would be you'd likely get some sort of bullishness around the 50% retracement zone, at which point I could potentially add to my existing long dollar positions. Speaking of which, my two positions that I currently have on the dollar are a long USD CHF trade and a long UUP, which is an ETF that tracks the US dollar against a basket of other currencies. Think of it as like being long the dollar versus the yen, long the dollar versus the Australian dollar, long the dollar versus the euro, etc., etc. And here's a look at my UUP position, up around $2,400 on this trade so far here. And so while jobs data has been a little lackluster, which is maybe a little bit more bearish for the US dollar, there's also been some really strong points to talk about. Like, for example, the GDP growth numbers, which have been much higher than expected in the second quarter of this year. With all three calculations for GDP numbers, the advanced, preliminary, and final GDP numbers all beating expectations in yellow. As I mentioned earlier, we also had strong retail sales numbers. Manufacturing PMIs are trending up and slightly beat the latest expectations, and unemployment rate remains relatively low. And yesterday we had the announcement of the ceasefire going on in the Middle East, which was, from a humanitarian perspective, great news, and from a gold perspective, not particularly great news. However, the trend is still very dominant to the upside, and there are many forces at play here in gold. And someone in my comment section actually made a comment saying, geopolitics don't really drive price of gold, Nick. And what I would say to that is that if you actually remember going back a couple years ago in 2023, this rally in gold prices actually started right around the beginning of the Middle Eastern conflict that we saw in the last few years. During that October 7th, event, we saw gold prices bottom out and continue to roar up. Now, of course, there's more than one reason why gold has gone up. There's also been the fact that, again, central banks have been cutting interest rates around the world, and I think that continues to buoy prices. There's also the de-dollarization trade that seems to be going on. So there's many forces at play here, but geopolitics do play a role, and I do think that part of the reason we had a little bit of a pullback yesterday was due to what is going on in the Middle East. Ceasefire, optimism in the realm is actually a positive thing, but it's not a positive thing for gold. And with my bullish bullish bias on the dollar currently, I wouldn't be surprised if gold prices do pull back. But let me be very clear, I am not bearish enough to actually place any trades. I do not have any short positions on gold, and I have no interest in shorting gold. I would, from a longer term perspective, love to see a pullback in gold prices, at which point I could potentially get long for the longer term. And when we look at gold prices in the Edgefinder's top setups overall calculation, you can see that it is getting a neutral reading. And this is because we have a mixed sentiment. Some of the economic data is actually suggesting dollar strength, which is not great for gold. But then there's also positioning and seasonality, and the overall trend still looks bullish for gold. So this is why I won't be taking any trades on gold and remain neutral on both silver, gold, and copper. Sometimes the best thing you can do as a trader is just wait. And if you don't have a copy of the Edgefinder, today is your lucky day, or potentially your lucky day. We're giving away 3 copies of the Edgefinder at the end of today. So if you want a chance to win, check this out. Inside of our free to join Telegram channel, we are giving away, like I said, 3 copies of the Edgefinder. All you have to do to enter for a chance to win is step 1, join the Telegram channel, which you can do so by clicking the link in the description down below or in the pinned comment of this video. Alternatively, if it's easier for you, simply scan the QR code that you see on your screen right now to join the Telegram channel. If you have the app on your phone, it takes like 2 seconds to join. Step 2 to enter into the giveaway for a chance to win is to navigate to the pinned message and simply fill out this form, putting your name and email in the hat. We will be emailing the winner at the end of the day, or I should say the winners. We're giving away three copies for free. So don't miss your chance to win. It is completely free to join. Let's also take a look at today's big mover. That is oil prices, down 2% today, taking out the lows here. Technicals still remain pretty bearish on this one from a daily chart perspective. We did have some support here that now seems to be acting as kind of a dynamic level of resistance. Check this out. So if we take a look at our supply zone, we did come back up, retest the 62 level, and the short sellers took it here to the downside. Where are we going with oil prices? Well, for that, let's take a look at the higher time frames. Could we be heading back down to the 56 level that we saw in April and May? Well, I'm going to actually go out on a whim and here and say I don't actually think that this is a price level that if we go to, we're going to go much further than. Let me explain what I mean by that. During the April sell-off, oil prices crashed lower because people were thinking, hey, the economies of the world are going to fall apart doing all the tariff stuff. But we didn't see that happen. In fact, oil prices rallied back. And I think from a fundamental perspective, oil prices are starting to look pretty cheap here. From a longer term perspective, if we really zoom out, take a look at the monthly chart here. I know that is super high time frame stuff, but if we go from the lows of 2020, we're kind of sitting around this 50% retracement. And I do think that there's actually the potential here that oil is in the ugly process of bottoming out and could actually start to grind higher here. With the economies of the world cutting interest rates, I do think that that could spur some growth, some economic bounce back. And with that said, I do think that the demand for oil will remain resilient. Obviously, we saw this huge spike in the price of oil in 2022 due to what was going on in Eastern Europe between Ukraine and Russia. But since then, we've trended lower and lower and lower. But I do think from a fundamental perspective that oil prices have limited downside with a lot more potential upside. That is my opinion from a longer term perspective. I personally have a hard time really getting too bearish at these levels. From a short-term perspective, maybe there's some trades to take. Trend still looks downward on the lower time frames. But again, I think from a big picture standpoint, oil prices are actually starting to look closer to a bottom than a top in my opinion. And I'll show you guys a trade that's not going too hot for me. I went long yesterday on XLE. This is the Energy Select Sector ETF. This is a ETF that holds a bunch of companies that are involved in energy, right? Think ExxonMobil and Chevron. And of course, there is some correlation here to what's going on with oil prices. So while I'm down on this trade at this time, if I stop out, it's my first attempt. But I do think XLE might actually be a place where I could get some value and I could see a bounce back. I'm trading this one long. If I'm right, great. If I'm wrong, it is what it is, and I'll take this stop. But I do just want to kind of highlight that, on my channel, I try and keep it real with you guys, both winners and losers. Oil prices are down. I do think on a longer term basis, I'm going to put my money where my mouth is, and I do think oil prices are starting to look pretty cheap here. Now, what you're looking at on the screen, you may have never seen before, even if you're a regular viewer of my channel. We're looking at the stock box, which is our tool that helps me to trade stocks, options, and ETFs. And specifically, you can see XLE is getting a pretty decent score of +8 on the stock box's top sectors indicator. Now, I love this one because I trade ETFs quite frequently myself, and I like the energy sector quite a bit. I also know that the energy sector is a little less correlated to the rest of the market than most of the sector ETFs. And so if the stock market pulls back, it's not a guarantee that XLE will go up, but it is a less correlated ETF. So stocks could come down while energy stock could actually do okay. I've now pulled up the historical PE ratios chart here within the stock box, and I've selected XLK. This is the technology ETF. And the reason I'm doing this is because my caution with stocks, and I don't want to sound like an alarmist or a doomsdayer or think that I think the market's going to crash per se, but we do know here on a historical measurement, stocks are expensive. There's no disputing that on a historical basis, tech stocks are very expensive. And what very expensive means to me is increased risk to try and pile in where everybody else is already piled in. So I am pretty cautious on stocks from a bigger picture, and I do also think oil prices are a little bit low on in a bigger picture as well. So while this is not necessarily an investment, I'm trading around this stuff, this does make me a little bit more cautious when it comes to buying and holding tech stocks. And again, I think that spreading out, diversifying, and trading in other places than just chasing tech stocks might be a decent move when we look back 3-4 years from now. And by the way, if you already have the Edge Finder or you are interested in just getting the stock box, send us a direct message using the link in the description down below. Let us know that you saw this in today's video, and we'll get you an extra discount. Especially if you already have the Edge Finder, we offer really significant discounts to existing members who are interested in trading stocks, ETFs, options, and want our tools for this. Many traders are familiar with the macro screener as well, which helps to not just look at the data, but also interpret it into stock market stuff, like which sectors look strong versus weak, these ones getting lower scores, how does the overall stock market look relative to the macro, etc. And if you like individual stocks, you can use the stock analyzer to look at the financials of companies that you may be looking at closer, like for example, Apple or Nvidia or Google or Tesla. Another way to explore this, if you want to just check out the tool itself, is head over to a1trading.com/stockbox. Here's a look at Bitcoin, which I think is an interesting one for me to watch. If we do get a pullback in the stock market, I've mentioned that from a trading perspective, I am still bullish the S&P 500 and the NASDAQ. I know I just mentioned that I think they're expensive, but that's big picture stuff. In the short term, momentum and sentiment can be a very strong driver of prices. And I do think that the stock market has room to get more expensive, or at least maintain the current PE ratios for a little bit longer. In the late 1990s, PE ratios went off the charts for multiple years in a row as the stock market doubled and then doubled again. So I'm not trying to call the top in any way when it comes to the stock market. I do think, however, that the more appropriate thing to do, even though I am bullish, is to wait for some resets, some pullbacks, as there's probably a lot of froth out there. There's a lot of people who are chasing with a lot of leverage in stocks right now. And I think that by waiting for these healthy corrections, you kind of work off the paper hands or the weak hands or the people who are over leveraged, and those are healthy things. So I'm actually very hopeful that we do get, and I should say hopeful in the sense that I'm not hoping that I make money or hoping that my strategy works out, but rather I'm just hopeful that we do get some opportunities to de-risk this stock market rally, as I want to see it continue. And I think that if you just melt up, there is an increased possibility that we go into bubble territory, and we could have some really ugly consequences for doing that. I think a healthy thing to stock market bulls right now would be to see some pullbacks. That would probably be, in my opinion, the healthiest thing that could happen for stocks would be to see pullbacks that sort of deleverage the situation and allow for the rally to broaden out and continue. And when we look at cryptocurrency, if you are bullish on the markets, I've always kind of viewed crypto as a way to, it's a trading vehicle to me. Like, I'm not necessarily a crypto hater or super believer, but to me it is a trading vehicle. If I think the stock market's going to move higher, cryptocurrency is a way to sort of capture some leverage without paying extra for it. And so what I mean by that is you could still lose more money because it's more volatile, but what I mean is you're not paying for like options premium or borrowing money through some sort of program, right? You can tap into the higher volatility that is Bitcoin without paying necessarily for the right to do so, like with options, etc. So when it comes to Bitcoin, I am an interested buyer on a overall market pullback. If you get a pullback into the 50 or 61.8% retracement, that would be a dip from the highs of, call it, 7 to 8.5% in Bitcoin prices. I would actually be potentially looking to take a trade around that area with a stop in case I am wrong about this idea. But I'm watching Bitcoin for pullbacks going into next week.
Hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.